You're scrolling through Reddit late at night and you come across a post that stops you cold. A guy, let's call him OP, is asking the internet for help. Not for himself, for his parents. His parents, who are in their early 60s, have almost no retirement savings, a mortgage they can barely afford, and a combined Social Security check of $2,200 a month. And the question he's asking is dead simple. Where can they even live? Now, maybe that story doesn't hit home for you personally, but I'm willing to bet it hits close. Because here's the uncomfortable truth. Millions of Americans are walking toward retirement the exact same way. No savings, no pension, no plan. Just a mortgage, a car payment, and a prayer that Social Security covers the gap. And spoiler, it doesn't. Not even close. Look, I'm not here to shame anyone. Life is messy. Injuries happen. Careers get derailed. People have kids instead of 401ks. I get it. But what I am here to do is make sure that if you're watching this, whether you're the parent or the adult child, you walk away today with a real, actionable roadmap for how to handle a situation like this. Because the options are not as limited as you think. And if you know what levers to pull and when, you can actually build something sustainable out of what looks like financial rubble. So let's start with OP's parents and what actually happened to them. Because understanding how they got here is the first step to understanding how to get out. Hello, I'm Am. Welcome to my channel. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Let's get right into it. According to OP, his parents had limited formal education. Dad worked a physical job on a farm, hard, honest labor. And then one day, a back injury ended all of that. Just like that, the income was gone. He received a settlement, $100,000, which sounds like a lot until you realize it had to stretch for years while they waited to become eligible for Social Security benefits. $100,000. Gone. Just trying to survive. Mom spent her years raising children. Again, not a knock, that is real, legitimate, exhausting work. But it meant she wasn't building a Social Security record or putting money into any kind of retirement account. She does some babysitting now to bring in a little extra, but in a small rural town, those opportunities are limited. So here's where they are today. $2,200 a month in combined Social Security, a $1,500 monthly mortgage, a $300 car payment, that's $1,800 in fixed expenses before they've bought a single grocery, paid a single utility bill, or filled a single prescription. The math doesn't work, not even close. And yet, and this is the part that surprised even me, they are not without options, not at all. Here's the thing that a lot of people miss when they look at a situation like this. They see no savings and they assume the game is already over. But OP's parents have something that millions of retirees would trade almost anything for: home equity. Substantial home equity, around $500,000 worth. Now, home equity isn't cash. You can't eat it, you can't use it to pay your electric bill, but it is a massive, latent asset sitting in that house. And if they unlock it the right way, it changes everything. Let me show you what I mean with some numbers that will genuinely shock you. If OP's parents sell that house, they walk away with roughly $500,000 after paying off the mortgage. Now, financial advisors have historically pointed to something called the 4% rule, the idea that you can withdraw 4% of your portfolio per year without running out of money over a 30-year retirement. But here's a critical update most people don't know. As of 2026, the updated safe withdrawal rate is closer to 3.9%. Based on current market conditions and interest rates. At 3.9%, $500,000 generates approximately $19,500 per year in additional income. That's about $1,600 a month. Add that to their $2,200 Social Security payment, and suddenly you're looking at $3,800 a month. That's a completely different retirement. That's a retirement where you can actually breathe. But, and I need you to hear this clearly, just selling the house is not a plan. It's the beginning of a plan. Because if they handle this wrong, they could lose thousands of dollars in healthcare subsidies, trigger a massive tax bill, and end up worse off than before. So let's talk about what to actually do. Here's the first big trap, and it's one I see families walk into all the time. OP's parents are in their early 60s. Medicare doesn't kick in until age 65. That means there's a gap, potentially several years, where they need to buy health insurance on the open market. And in 2026, the Enhanced Affordable Care Act subsidies that were available in previous years have expired. The income caps are back. What does that mean practically? If their income exceeds 400% of the federal poverty level, which for a couple in 2026 is somewhere around $73,000, they lose their ACA premium tax credits entirely. A sudden flood of income from a home sale, if it's not managed carefully, could push them over that threshold and cost them thousands of dollars in health insurance premiums during those pre-Medicare years. So this isn't a sell the house fast and dump everything in the stock market situation. This is a carefully sequenced, tax-managed transaction, and it is 100% the reason why talking to a fiduciary financial advisor, not a salesperson, a fiduciary, is not optional here. It's mandatory. A fiduciary has a legal obligation to put your interests first, not their commission, not their quota. Your interests. That distinction matters enormously when we're talking about structuring the sale of a $500,000 asset during the most financially vulnerable years of someone's life. Now, selling the house isn't the only option on the table. Let me walk you through a few alternatives that are genuinely worth considering, because depending on the family's situation, one of these might actually be a better fit. Option 1. The ADU strategy. ADU stands for Accessory Dwelling Unit, basically a small secondary home built on someone else's property. If OP or one of his siblings has a yard or extra land, the family could use a portion of that $500,000 in home equity to fund construction of a small living space on the adult child's property. The parents move in. Their housing cost drops to essentially zero. They keep their equity invested and generating income, and they're close to family, which, as we'll talk about in a second, becomes increasingly important as dad's disability potentially worsens. This isn't some weird fringe idea. Multi-generational living is exploding in the United States. According to Pew Research, roughly 60 million Americans, that's nearly 1 in 5, now live in multi-generational households. It's becoming the norm, not the exception, especially for families navigating the financial squeeze that retirement has become for so many people. Option 2, the reverse mortgage. Now, I know the word reverse mortgage makes some people flinch. There's a lot of bad press around them, some of it deserved. But the specific product worth knowing about here is called a HECM, a home equity conversion mortgage, and it's federally insured. Here's the basic idea. Instead of making monthly mortgage payments to the bank essentially makes payments to you, drawing down against your home's equity. You stay in the house, you stop making mortgage payments, the loan doesn't come due until you sell, move out, or pass away. For a couple struggling to cover a $1,500 mortgage, eliminating that payment without having to relocate is genuinely significant. One important catch. HECM borrowers must be at least 62 years old, so depending on exactly how old OP's parents are, they may need to wait a bit. But it's worth knowing this option exists and putting it on the timeline. Option 3, which multiple people in the Reddit thread suggested, move near the kids. This sounds simple, but it's actually a layered financial and lifestyle decision. If OP's parents relocate to a city where their adult children live, they gain access to informal support, rides, errands, help as dad's disability evolves. If they move to a walkable neighborhood, they might be able to eliminate the $300 monthly car payment entirely. Proximity to family also reduces the likelihood of expensive emergency interventions down the road, the kind that happen when aging parents are isolated and something goes wrong. The one major risk of moving into a rental is exposure to annual rent increases. When your income is fixed, Social Security doesn't grow fast enough to keep pace with aggressive rent inflation, being a renter in a hot market is a real vulnerability. It's not a deal breaker, but it's something to factor in. Let's talk about income, because I don't want to let mom's situation slide by without addressing it directly. She's got experience with childcare. She's been doing it informally. But the world has changed a lot in terms of flexible income opportunities for people in her position. If she's physically able and willing to work, her childcare background is actually valuable in a formal setting. Daycare centers, after-school programs, summer camps, and teacher's aide roles are all options that don't require physical labor the way a lot of jobs do. And here's something I want to emphasize. Even a part-time role bringing in $800 to $1,000 a month would be genuinely transformative for this couple's monthly budget. Beyond traditional employment, the gig economy has opened up flexible options that didn't exist a generation ago. Virtual tutoring for younger students, remote customer service roles that can be done from a laptop, pet sitting through platforms like Rover, which lets you set your own schedule and rates. These aren't glamorous, but they're real income, and they fit around health limitations and unpredictable schedules in a way that a 9-to-5 never could. The key point is this: every dollar mom earns reduces how hard that $500,000 in home equity has to work. Income from work is a multiplier on every other financial decision they make. Okay, so let's say OP's parents do sell the house. They've got $500,000. Now what? Where does it go? This is where a lot of people make a massive mistake. They dump it all in the stock market, freak out during the first correction, sell at the wrong time, and watch their retirement fall apart. That is not a plan. That is a gamble. What the money actually needs to do is two things simultaneously: generate reliable, predictable income right now, and grow enough to keep pace with inflation over the next 20 to 30 years. Those are not the same goal, and they require different tools. For the income piece, there are two strategies worth knowing about. The first is a treasury bond ladder, basically a staggered series of U.S. government bonds that mature at different times, providing a predictable cash flow stream over a set period. They're backed by the federal government, they're low risk, and they generate better yields right now than they have in over a decade. In the current interest rate environment, a well-constructed treasury ladder can generate meaningful income with very low risk. The second option is something called a single premium immediate annuity, or SPIA. You give an insurance company a lump sum, say $200,000, and they send you a guaranteed monthly check for the rest of your life. It's essentially buying a private pension. You can't outlive it. For people without a traditional pension, which is the vast majority of Americans today, a SPIA can anchor the income side of a retirement portfolio in a way that nothing else quite replicates. The key is not to bet everything on one strategy. A blended approach, some in a treasury ladder for near-term income, some in a SPIA for lifetime income security, and some in a diversified portfolio for long-term growth, gives you multiple layers of protection. Think of it like a three-legged stool. Pull any one leg out and the thing falls over. Keep all three in place and you've got stability. Here's a fact that I think puts all of this in sharp relief. According to the Federal Reserve's Survey of Consumer Finances, the median retirement savings for Americans aged 55 to 64 is approximately $87,000. Not $800,000, $87,000 for the median household, meaning half of all Americans approaching retirement age have less than that. Social Security's average monthly benefit in 2026 is around $1,900 per person. For a couple, that might be $3,500 to $4,000 a month, which sounds okay until you factor in inflation, healthcare costs, and the reality that the average American will spend nearly $300,000 on healthcare in retirement, according to Fidelity's annual estimate. The retirement crisis in this country is not a fringe problem. It is not happening to some small group of irresponsible people who didn't try hard enough. It is happening to tens of millions of families who were never taught how this works, who trusted that Social Security would be enough, who hit unexpected obstacles, an injury, a divorce, a layoff, a sick child, and couldn't recover in time. OP's parents are not outliers. They are the median. And the fact that they have $500,000 in home equity is actually what separates them from the families in truly dire straits. So let me bring this all together into a practical sequence of steps, because I don't want this to end as an interesting story about someone else's parents. I want it to be a wake-up call with a roadmap. Step 1. Get a real picture of the numbers. Not an estimate, not a rough idea, a full accounting of income, expenses, assets, and debts. This is non-negotiable. You can't fix what you can't see clearly. Step 2. Consult a fiduciary financial advisor before making any major moves with the home equity. The tax implications of a home sale, the ACA subsidy cliff, the optimal investment structure, these are not DIY problems. The cost of getting this wrong far exceeds the cost of professional advice. Step 3. Evaluate the housing options against total cost of life. Not just the mortgage or rent, but transportation, proximity to healthcare, proximity to family support, and long-term rent exposure. These factors compound enormously over a 20-year retirement. Step 4. Build a diversified income strategy with the home equity proceeds. Don't just invest it, structure it. Use a combination of guaranteed income tools and growth-oriented investments so that you're protected against both running out of money and falling behind inflation. Step 5. Explore mom's income potential, not as a burden, not as a necessity, but as a genuine asset that buys them more options and more breathing room. Even modest income extends the runway dramatically. And step 6, and this one is the hardest one, have the real conversations now, not after the crisis. OP is already asking the right questions. His parents are lucky to have him, but the families who navigate this best are the ones who start planning before the house is underwater, before health deteriorates, before the options narrow to one. Here's the thing I want to leave you with. OP's parents are in their early 60s. They have a disability, no savings, and a mortgage they can't afford. And I just walked you through 6 different strategies that could, with the right execution, give them a genuinely secure retirement. Not a fantasy retirement, not a luxury retirement, but a stable, dignified, sustainable one. That is what good financial planning can do, even late in the game, even when it looks hopeless. The $500,000 in home equity is not a windfall. It's a lifeline. And if they treat it like one, if they are disciplined and strategic and get the right professional help, they can turn it into an income stream that lasts decades. Now, if you're watching this and you're the parent in this story, or if you know someone who is, please share this video with them. Not to shame them, not to pile on, but because the worst thing that can happen is to keep hoping things will work themselves out without making any moves. And if you're the adult child, if you're the OP in this situation, trying to figure out how to help, know that asking the question is the most important step. You asked. That matters. Now take the next one. And if you're younger and you're watching this thinking, that's not going to be me, good. Hold on to that. And then go check your retirement account today. Not tomorrow, today. Because the families who end up fine are not the ones who were lucky. They're the ones who started having uncomfortable conversations just a little bit earlier than everyone else. That's it for today. If this helped you, hit that like button. It genuinely helps this channel reach more people who need to hear it. And drop a comment below. What's the one retirement question you've been avoiding asking? Let's talk about it. I read every single one. See you in the next one.